Okay, good afternoon. This is Wei Jiang from Emory University Gazeta Business School. It is my honor to make this introduction. It is not easy to pick a topic for the AFE lecture, but when the right one comes along, it became choice obvious. In spring 2025, I had the pleasure of listening to Jim Poterba speak on the intricate relationship between US public debt and economy. It occurred to me suddenly that almost everything in finance that we study, from asset pricing to corporate finance, to household finance, or even to sustainability, are conducted against this very backdrop Jim was deciphering. It also occurred to me that no one beats Jim in both the length of research service and the height of accomplishments in this domain. At that point, there was a real sense of closure around the choice of speaker for this AFE lecture. So I'm sure you already know a lot about his luminary CV, but a proper introduction is still owed. Jim Poterba is Matui Professor of Economics at MIT and the President of the National Bureau of Economic Research, NBER, a nonprofit research organization with more than 1,800 affiliated academic economists. He is an AEA-AFA veteran as a distinguished fellow of both associations and a former AFA director. He's a member of the National Academy of Sciences and has served as a president of the National Tax Association. His research straddles the fields of financial economics and public finance and has a long-standing interest in the impact of taxation on the saving and portfolio decisions of households, particularly those research associated with retirement planning. His research has explored the determinants of retirement saving, the drawdown of assets after households reach retirement, the impact of tax-deferred retirement savings programs such as 401k or 403b, and the functioning of the annuity markets. In addition to his academic roles, Jim also chairs the Board of Trustees for the College Equity Retirement Fund, which affect many of us, which was established in 1952 to provide variable annuities to college and university faculty. Because the choice between tax and debt financing for government spending is one of the central issues in public finance, especially in the US, Jim has a long-standing interest in the dynamics of budget deficits. He serves on the panel of economic advisors for the Congressional Budget Office, the nonpartisan agency that is a go-to source for analysis of federal debt and deficits. He also served as a member of the President's Advisory Panel on Federal Tax Reform in 2005. Jim has studied the historical pattern of debt repayment following run-ups in federal borrowing, and he claims that his interest in taxation and government spending started well before graduate school. He was an active member of his high school's debating team, and as a freshman, the national debate topic was about federal government financing of local school districts in the US. He was introduced to questions about fiscal policy then and has been hooked ever since. In his talk today, Jim will describe the rise in federal debt that has taken place over the last 2 decades and implication of this development for financial markets as well as the long-term economic growth. He will approach these issues from the perspectives of both financial economics and public finance. So here is Jim. Look forward. Thank you.
Wait, thank you very much for inviting me to come and deliver this lecture today to the AFA. It's a great honor, and I will try to live up to your hopes of managing to distill some of the economics as well as the finance research around federal debt, budget deficits, and some of the issues around the functioning of the Treasury market. I will confess that I was attracted to this set of issues as a current research issue for just the reason that Wei mentioned in the beginnings of her remarks, that the Treasury market, of course, is one of the largest financial markets in the world. It is central to most of us, at least the textbook version of how we would search for and take a risk-free rate in most capital markets would lead us to think the Treasury market was a place to do that. And it's also a market which attracts enormous attention, not just in finance circles, but increasingly in a somewhat broader community. I would point you to this slide, which is a picture from the Wall Street Journal in February of last year. This is the American eagle weighed down by sandbags of government debt. The immediate stimulus to this particular slide is that the U.S. interest payments as a share of GDP by the federal government have recently exceeded military expenditures in the U.S. And if one looks back historically, this was Neil Ferguson, the economic historian, pointing out that that is a harbinger of the beginning of decline in civilizations as far back as the Roman Empire. So at least in a community which is beyond that here at the AFA, the dynamics of debt and deficits has attracted some interest at the moment. So my plan for this afternoon is, and reminding you that I am someone who comes from the tribe of public finance economists on the econ side, but work and am very interested in a set of issues around financial markets. I'm going to start by basically doing an introduction to the quantities associated with debt and deficits, describing what the deficit is, how the integral of deficits turns out to be the debt, and what those look like both historically and then more importantly projected as we go forward. Then I'm going to shift gears about midway or a little bit later through and start to talk about the financial market side of all of these things. That's when I'm going to mention interest rates, and then we'll get to discussing things like maturity structure and the microstructure of the Treasury market, because I actually am on a bit of a mission here today, because I think there is actually a great need for more interaction between the financial economics community thinking about these issues and the public finance community thinking about these questions. And to take just a simple example on something like what is the optimal maturity structure of the government debt, that is not a question that gets much attention with my public finance friends, and it gets some, but certainly more attention amongst folks in the financial economics community. And I think it would be great to somehow bridge those two communities. So, but I hope along the way I'll share some things about the dynamics of U.S. debt and deficits, which you will either find a refresher course or new content, and then manage to try to link these two things at the end. And I should say most of what I'm going to do is just synthetic. This is not a new, let's unveil new research findings, and I will apologize in advance to those of you in the audience or watching on the video later on who have done work that is closely related to the topics that I'm mentioning and that I somehow have managed to overlook in my presentation. So I want to start, as we do this, by looking back for a little bit of U.S. economic history, but only looking back 25 years. Okay? The Congressional Budget Office is the traditional forecaster in the federal government, the nonpartisan forecasting arm that projects where current law and current deficits will take the U.S. debt trajectory over the next 10 and sometimes 30 years. This slide is from the Congressional Budget Office's report in year 2000, beginning of 2000. And it basically shows debt to GDP in the US, right? The peak of debt to GDP at about 110% at the end of the Second World War, a rather sharp decline in the 2 decades after that, a bit of a run-up that takes place in the 1980s, a plateau and then actually a decline that begins in the mid-1990s. And it shows that if you were projecting in early 2000, what was going to happen with U.S. debt, it looked like by around 2012, we were going to run out of federal debt. We were going to retire the federal debt entirely, given the trajectory we were on. And some of you who are here this afternoon, I know, will probably recall that we were having discussions at that time about what we would do with the surplus that was going to be generated by the federal government. And some of the proposals that emerged were, for example, we might see the federal government purchasing assets in private companies as they found a way to deploy the assets which were the income that was coming in with taxes that now exceeded government spending. Well, this curve changed shortly after this. The dot-com bust, the beginning of a variety of military engagements that in the first decade of the century increased federal spending, followed by the global financial crisis, got us to a rather different place in 2012. The federal government did own significant stakes in a number of private sector companies, but it was not as a result of investing the surplus that was coming in, but rather as a result of the bailouts that went along with the global financial crisis. So we got to a somewhat similar place, but by a rather different route along the way. If you were to update this very same slide to today, you can still see, and add the longer-term projections, you can still see the World War II peak, but now it looks very different because we, in fact, no longer does the World War II peak seem to stand out in the graph. Rather, it's a U-shaped graph, broadly speaking, which, as a result of increases in debt that took place during the global financial crisis and the aftermath, a continued gradual buildup during the decade of the 2010s, and then another significant spike during the COVID-19 pandemic, right? We've now reached a place where the US debt to GDP ratio, debt held by the public, is around 100%, okay? And more concerning, the projections do not look anything like what happened after the Second World War. Because today's deficit, as one projects going forward in terms of the current laws on the books, suggests that we will continue to see significant deficits as we look out for the next 30 years, which takes us to a place by 2055 that the CBO thinks will include a debt to GDP ratio of something more than 150%. And I'll say a little bit more about exactly where that may be pre and post the One Big Beautiful Bill Act of 2025, but in the range of 150%. Now, if you just pause for a second and say, oh my goodness, what are we going to do about that, right? There are countries, notably Japan, that has a significantly higher debt to GDP ratio than 150%. But most of continental Europe is well below this level. And in fact, the US is now at the high end of many of those countries. So the question this is all raising is, we are entering into, in some sense, uncharted territory for the US for sure. And I think this graph alone, if you take nothing away from this afternoon, suggests that we are in a place where the fiscal trajectory of the US may actually cause new things to happen in financial markets that we have not experienced before. And I think that really is the hook for thinking about these questions, that as we run up this level of Treasury debt, particularly at a time when much of the rest of the world may also be incurring significant debts, the question is, what's that going to look like and what are the implications? Now, this, of course, as I said, the debt's basically the integral of the deficits year upon year. If you look at the deficit forecasts from the CBO, not surprisingly, you see spikes that occurred in the global financial crisis and then again in the pandemic when we hit around 14% of GDP as a deficit in 2020-21. But as you look out to the forecast going forward, you notice that this category, which is the pink, the net interest outlays as we go forward, starts to become significant in a way that it hasn't been since the late 1980s and early 1990s. And what that simply reflects, of course, is the dynamic of as you build the debt stock larger, you start to pay more interest on it going forward. And as I'll say in a little bit, it also involves critically, as you look at the decade of the 2010s, the dynamics of what interest rates on Treasury debt looked like and how that interacted with the continual accrual of new debt as we go forward. So this is the Congressional Budget Office basically forecasting what deficits will look like as we try to go forward from here, assuming that the laws currently on the books are what govern U.S. fiscal policy. Now, of course, that's, in some cases, the law includes phase-outs of provisions that are in tax bills, and this assumes that they will phase out as expected. In many cases, those provisions don't tend to phase out. Congress tends to extend them. The Congressional Budget Office cannot assume that that's what's going to happen because it is by statute required to basically do these calculations using what's called current law, and that's what this is. Okay, so the reality might turn out to be a bit different, and I think we might in fact see something which is a bit worse than what we see here. If you were to look and say, give us an idea of what the debt looks like, right? Today, U.S. government debt held by the public is about $31 trillion. Okay. There is additional debt issued by the federal government that is held within the Social Security Trust Fund and a couple of other federal trust funds. That is not in the debt held by the public. The debt held by the Fed is in the debt held by the public. So as we try to think about the ownership here, that's important. Okay. That means debt per household is a number like $230,000 a year in the U.S. or $90,000 a person. And importantly, and I'm just going to begin to get a little ahead of myself here, as we think about the maturity structure and what the pressure on the funding markets are, about a third of this outstanding federal debt will actually need to be refunded during 2026. So we've got about $10 trillion of debt that will come to be refunded during the coming year. And that reflects a set of decisions about maturity structure that were taken during the early days of the pandemic. And I'll come back to that a little bit later on. If you look, and the IMF is one of the institutions that is beginning to raise an alarm about accumulating global debt levels. And the IMF points out, for example, that at the end of 2025, globally, gross government debt as a share of GDP is a number like 95%. The gross number would actually, for the U.S., be higher than the 100. It'd be closer to 120. So, in fact, it's the U.S. is a little bit higher than the globe here in terms of what's going on. If you look to just get some sense of how this lines up against other countries, this is a simple histogram that looks at 2024. The U.S. here, this is again the gross public debt number, which is the IMF's comparable across nations, is about 125%. You see Japan there at some number like 240. And, the sort of Italy is a little bit higher than the U.S. is. France, Canada, about the same place. The U.K. coming up on our heels. Germany, of course, is the most, most conservative of the countries the large countries in Europe. And they're basically somewhat lower at a little over 50%. But, for the U.S., this is taking us to a place that at least historically we have not been. Now, if I were going to give you a quick, and I'll try to avoid being long on this, putting the government sector in context as part of thinking about this, this is showing government spending as a share of GDP, taxes as a share of GDP, and then the deficit as a share of GDP for a number of countries. Okay? And what you see is that broadly, the U.S. is high on the deficit dimension at the moment. Okay? But the U.S. is actually relatively low on the tax as a share of GDP, and even pretty low on the government spend as a share of GDP relative to other countries. And I think this is actually an important fact to keep in mind as we carry through the discussion, because it raises the question of kind of unused fiscal capacity and whether there are tools, given political will, that could be used to collect additional revenue if that in fact were to become the case, right? And that's, much as I will conclude, much of the issue around the dynamic of the federal budget deficit and the debt is really about the politics more than it is about the economics per se. But I will not have anything very insightful to offer on that issue, although I do want to flag it for your attention. Okay, and if anyone who's interested in pursuing, the IMF is the ideal source of information that looks at this in a global setting, and the Congressional Budget Office is the right place for most of the discussions around the U.S. One other thing to keep in mind about the sources of the run-up that we face in terms of the deficit going forward, there are mandatory spending items in the federal budget. Social Security payments, which are by statute to be delivered, Medicare and Medicaid, which are programs that people are eligible for and can't scale back if people are eligible to get them. And then there are discretionary programs like the National Science Foundation or the defense spending as part of the discretionary budget. That can change year to year. And then there's net interest, which of course is just a number ground out from whatever the capital markets deliver given the size of the debt that's outstanding. A key thing to recognize is that as the CBO is doing its projections going forward, it is actually assuming that discretionary spending as a share of GDP will be declining over the next decade, and that mandatory spending will actually be rising. And that fact is key as we think about the political economy issues here, knowing that many of the expenditure drivers are coming from these autopilot programs, which are left alone, basically just tell you these are benefits that have to be paid out. That makes it doubly difficult to think about what the adjustment mechanisms would be as we go forward. And importantly, the tax code is something which one can in fact intervene with and change. And therefore, there's at least an argument that it may be easier to make changes politically on the tax side than on some of these expenditure programs. I don't think I'll get to this at the end of today, but many of you probably know, the Social Security program as currently structured has a trust fund of resources. This is where some of those $8 or so trillion of federal bonds that are held within the federal government are lodged. That trust fund is projected to basically run out of money at around 2033 or 2034. When that happens, the immediate thing that occurs is that the inflow of payroll tax revenue from FICA taxes to Social Security is significantly lower than the outflow of benefits to Social Security recipients. So the tax inflow is about 75% of the outflow. Unless someone does something legislatively, that means that benefits to Social Security recipients will be cut by about 25%. I don't think that scenario is very likely to happen, and there are many ways out of it that we might talk about in Q&A. But just to understand that that is actually one trigger which may lead to some action on some of these budget deficit issues as we look forward at the next decade or so. Can't talk about these issues without at least thinking about the question, what was the impact of the One Big Beautiful Bill Act on the deficit going forward? Most of you, I think, know it was an adverse impact in the sense that it raised the size of budget deficits going forward. The chart here, which is taken from a very helpful study by Alan Auerbach and Bill Gale, basically looks at the projections of the budget deficit out to 2050 that basically are looking at where we were in March of 2025. So this is essentially the Congressional Budget Office or something very similar at that time. Then it's looking at where we would be in July of 2025, and that's after OBBBA passed. And then the dotted line, which is the highest of these, is what's called current policy. And that's, although the CBO is not allowed to deviate from here is what the law of the land tells us, Alan and Bill are free to do that calculation, and this is their saying essentially what is the likely path if things that are scheduled to expire don't expire, what's going to happen to the deficit level. So what you see is that we added on something which was on the order as we look out to these years, maybe another 2 to slightly more percentage points of deficit as a result of OBBBA, and that was relative to the baseline in March of 2025, which had a number of the provisions in the 2017 Tax Cuts and Jobs Act expiring, right? So to understand what this was doing, that bill was going to generate additional revenue because tax provisions were going to expire. That's what CBO was scoring. And when you extend all of that, you end up in the place that the higher lines, the solid line, and then the very, very small dotted line look like. So this basically gives you a sense of thinking about where we are headed. Again, on the if you translate this from from the flow, which is the deficits, to the stock, which is the debt, their calculations suggest that we would have been headed for about 150. We are now headed for numbers which are in the high 100s, getting into the range of close to 200% debt to GDP as we look out to 2055. And of course, I should be very clear as I put these slides up for you. We all know that there's a great deal of uncertainty about what these numbers will look like when we actually live through this. And hopefully my demonstration of CBO 2000 versus CBO today gives you a sense of how much can happen in 25 years. And that can mean policy, it can mean shocks. And of course, the topic du jour for debate is what might the AI boom do in terms of productivity going forward. And if you want a rough and ready way to think about some of this, if GDP grows by another 0.5% a year, GDP is going to be bigger in 30 years by 15%, a little bit more when you accumulate, and that at a minimum is going to mean that the debt to GDP ratio would be 15% smaller, and likely even more because you get additional revenue along the way if you were getting this kind of growth. Depends a little bit on how the growth plays out. If you get a lot of unemployment as a result of the AI-driven productivity boom, the economy generates revenue, but you also have to spend on unemployment insurance and other benefit programs potentially. So, these are complicated, but recognize the uncertainties that are here. Some of you are probably thinking, what about tariffs? Aren't we collecting a bunch of revenue there? So I can't resist. I'm not a trade economist. I'm not going to tell you what we're doing. It is true that we are expecting to raise significant revenue from tariffs, okay? But with a deficit that in one of my charts, is running in the 6 to 7% of GDP. GDP is basically, $30 trillion a year at this point. So this is in a $2 trillion deficit setting. A couple of $100 billion in tariff revenue is nothing to sneeze at, but it's not going to close the numbers that we've seen here. And this is also one of the things with tariffs is that they're a little bit like taxing cigarettes. You collect more revenue at the beginning than you do as you go forward as consumer demand patterns adjust. So the tariff revenue stream, unless you keep juicing it with higher and higher tariffs, you actually see a declining stream. And of course, the open question of the retaliation remains outstanding, and that could have consequences in the other direction for GDP growth in the US. All right, so that's, that's kind of my facts, right? That's just kind of where we are and what the pattern looks like going forward under current law, under best forecasting technologies we've got at the moment. Let me shift for just a little bit and ask the question, what is the burden of the debt? I mean, how do we think about having this larger debt stock, and what would be the concern as we think this through? Well, I mean, there's sometimes an argument though, don't we owe it to ourselves? Somebody owns it, somebody owes it. Can't we just erase it all? I mean, that argument, of course, doesn't quite work for two reasons. First, about a third of the debt is held by foreigners, so we can't just, unless we default, we can't just sort of erase that. But even within domestic ownership, there's heterogeneity of who the owners and the owers are. The owers being those who would be taxed under the provisions that would pay off the debt if we did that, and the owners being those who have these assets in their portfolios. But ultimately, the real burden of the debt, and I'm just reminding you of what was in your intermediate macro course at some point, the ultimate burden of the debt is that it's a portfolio asset for asset owners, and it crowds out the productive capital assets that might otherwise be owned in the absence of the large stock of debt. So if you needed just a sentence or two on this, it is that if we didn't have a large debt stock, then there would be more capital available to deploy in plant and equipment and in R&D accumulating in intangible assets and in other things, in housing and all of those other things that would change the productivity of the economy in a positive direction, and that by issuing all the debt, we basically extinguish the possibility of that to some degree. And therefore, the crucial question is, well, how much? How much crowd out is there, and what are the productivity effects and GDP effects of doing that? So I'll give you two parts of an answer to that question. Okay, if you think about the mechanism, ultimately we're now starting. This is the first time I've said anything about a price in the economy. If you think about how we get from the stock of debt to having less capital, real capital in the economy, ultimately that's mediated through an interest rate like variable. And more debt must mean a higher interest rate, which therefore means that we invest less in productive capital so that the marginal productivity of capital ends up being higher. Okay? And how much? Okay, well, the Congressional Budget Office, which is in the business of boiling the ocean of empirical estimates of how interest rates are affected by debt, concludes that a 10% increase in GDP, debt to GDP for the US, translates into about a 20 basis point increase in 10-year Treasury yields. Right now, I wouldn't go trade on that number, but that gives you at least a ballpark of what kind of magnitudes we are thinking about. So, you can decide either to rest easy or be concerned depending on what you think about a 50% of GDP increase in debt to GDP between now and 2055 in 30 years, multiplied by what I just given you, is a 100 basis point increase in the real interest rate. Okay? That's a substantial change, and we'd have to feed that through to a smaller capital stock. But that's the kind of shock that would be associated with what I've been describing so far in terms of my quantities. Okay? And of course, the 10% GDP to 20 basis points thing is likely to be sensitive to the evolution of the Treasury market, who the participants are, and the degree of global integration, as well as the debt incurred by other governments that are issuing sovereign bonds that might be close substitutes to those issued by the Treasury. Right? So all of those things fit together as we begin to think about how this is going to work together. The last thing I will mention on this point, and it's actually the place where I think we have the least evidence at this point, although it could be a very important consideration, is that as we run up the debt to GDP for the US, the risk of something going bump in the night in the Treasury market may go up. Right? And I'll say a bit more about some of the dislocations we've seen in government debt markets, both in the UK and the US, as a kind of warning sign to, do we need to take the operation of the Treasury market more carefully and study it as part of what I think we would want to focus on as we go forward. If you were to look at a plot of basically the sort of debt to GDP under a, this is basically per capita GDP. The vertical axis here is just income per capita, right? Per capita GDP. This is doing this under two different scenarios to figure out what the effect is of having a higher debt stock. The blue line is basically we hold debt to GDP at the current 100% level for the next 30 years. And the orange line is we allow the debt to GDP ratio to rise to something around 165 by 2055 or 2060. What you see there is that produces something on the order of a 7 or 8% decline in per capita GDP. Okay, so that's the mapping this, what I've just done is with just some graphs, something that many of you would do with a full-blown Henk model and simulations. But I've just said, you run up a stock of debt, it crowds out some physical capital. The physical capital means that you've got a smaller aggregate supply of capital, so workers are less productive and the economy produces less, and then you divide it by population and you come up with this line. Okay, so this is ultimately that there is a real consequence of all of these things. What happens with this? I mean, one possibility is we just live this scenario. There are other scenarios, and I want to mention, folks, what would you need to do to avoid what I've just shown you in terms of debt to GDP? We're still doing quantities here, right? And this is a chart which is put together again by Auerbach and Gale. The Congressional Budget Office does something similar. It asks the question, if you wanted to stabilize debt to GDP at the current level, or if you wanted to stabilize it at 150% of GDP, so stabilize when you hit the numbers around 2050, 2055, how much would you need to narrow the budget deficit? And this is the fiscal adjustment that we would need. What you see is that if you wanted to stop the growth today, you'd need to basically raise you need to raise taxes or cut spending by something like 3% of GDP. Okay? And if you waited a few years, it gets a little bit more. The longer you wait, the bigger the hole is and it takes more digging to get out. If you wanted to do it under the assumption of current law, that's a number like 3. If you do it under current policy, which says we tend to extend a lot of these provisions, that's a number like 3.5%. You wait 5 years, it's almost 4%. Okay? If you're willing to stabilize at 150% of GDP and take the chance that nothing goes wrong along the way, you can do it with a smaller adjustment in terms of the deficit. Now, the challenge here in some sense is the political will to narrow deficits at the moment seems to be very, very small in the U.S., right? There wasn't really much of a pushback on doing things in the OBBBA, which had the effect of adding significantly to the deficit as we go forward. So I think at least reasonable people might conclude that thinking about adjustment in 2026 is rather optimistic. Thinking about adjustment in even 2031 may be rather optimistic. And that leads to the question of, okay, so what might happen? Is there anything that kind of gets us out of this? I'll call it unsustainable in the sense that we are clearly moving away from the historical range of debt to GDPs and into something new. So what might happen? Okay, there are basically Greg Mankiw gave a very neat talk at the NBER last summer. It's been picked up widely in some of the economic press that basically says, look, there are 5 possibilities here. One is that we get extraordinary economic growth and it helps us out, right? That's the AI or other scenario, which just says that the economy does really well and that grows us out of this. Now, it is, as I said, really hard to grow out of everything I've just shown you. So the more likely scenario is growth helps. Okay. The flip side of this is if we don't get really good growth, this gets worse, right? So the CBO is trying to forecast based on average growth rates over the past. So if we underperform on those dimensions, then in fact the hole gets bigger as we go. Second scenario is the government just defaults on some of the debt. Now, I don't think anyone talks about default in a serious conversation at this point, and I wouldn't want to put this on your radar screen in any sense, but there are examples in which we have seen things that come pretty close to a default on at least part of the debt stock outstanding, right? So the view that says the U.S. could never default on anything, turns out we have defaulted on some parts of our outstanding debt stock several times in the last 100 years, right? In 1933, we basically abrogated gold clauses in U.S. government bonds, so the convertibility to gold, FDR just said, we're not doing it anymore. End of discussion. Okay. In 1968, some of you will probably remember, there used to be silver certificates that were in circulation. They were redeemable for silver. Okay. Well, then we said we weren't going to do that anymore. So we took away that convertibility. And there's actually there was something associated in 1971 with foreign debt holders no longer being able to redeem dollars for gold under Bretton Woods, although that got less attention, at least in the U.S. So there at least are some things, there could be minor things along the lines of we claw back some of what we've promised to do. Next possibility is inflation. Okay, and inflation certainly is something that's out there. The Economist magazine this fall talked about the coming debt emergency. Those of you in the back who can't see on the life jacket, the little fine print says "pull here for inflation." So inflation, of course, why inflation? Well, you can inflate away part of the debt. Right? Now, you can't inflate away tips because they're inflation indexed, but a relatively small stock of the outstanding debt is tips. You can inflate away a lot of the nominal debt stock that's outstanding, but only until it matures and you then pay the higher interest rate, which builds in the expected inflation going forward. Okay? And actually, the hard thing is, remember that I told you that a lot of the deficits for the next decade or so, or next 3 decades, are coming from those entitlement programs. Social Security is indexed. Medicare and Medicaid are basically real claims on health services by people covered by the insurance programs. So you actually can't inflate them away very well, right? The inflation does not let you reduce those liabilities. They just continue along and you have to meet those obligations. So the power of inflation to reduce and improve the debt circumstances here is somewhat limited by these considerations. But this is something where just understanding what the numbers look like on this is a question where at the intersection between financial economics and macro, it requires thinking through the Irving-Fisher relationship and how quickly nominal interest rates would adjust as inflation picked up and various things like that. There's certainly more to do here as we go forward. In the Mankiw taxonomy, large cuts in government spending are, the next possibility. Of course, anything might happen, but cutting Social Security, Medicare, and Medicaid seems like it's pretty difficult. Okay? Government defense spending, if anything, we probably live in a riskier neighborhood than we have done before, so that makes it a little more challenging to be able to to get progress on that front. So that, I think, leaves you kind of as the best house on the kind of crummy street, thinking that significant tax increases might be the place where we would go if we were trying to move to narrow these deficits as we go forward. If you were trying to think, what might we do there, let me just give you a little public finance on, what some of the options might be and what they might raise in terms of revenue. Right? So say you just raised all the federal income tax rates by 1%. Okay, I change your 37 to 38. I change the 10 to 11, 15 to 16, about $100 billion a year. Okay, broadly speaking. So it's across the spectrum. So 5% increase, you get half a $1 trillion. That doesn't solve the problem, but it makes a significant step. Eliminate the employer tax deduction for employee-provided health insurance. Right, $100 billion a year again. Most economists would line up for this is a distortion. We over-provide health insurance, and we'd actually get some efficiency gains here. Never gets any political traction, but it's something to think about. Repeal capital gains basis step up at death, $50 billion a year as we go forward, and probably eliminate some distortion that many people in this room could describe in terms of lock-in of effects of investors into assets being held until death. Change the FICA tax, the Social Security payroll tax, to pick up more of the earnings that are being earned. One thing that's happened in the last few decades in the US is the earnings distributions become more unequal. We have a cap on Social Security taxable earnings, which is set and then indexed to wage growth. But as the distribution becomes more spread out, that means more of the earnings are actually above the cap. If you just went back to where we were a couple of decades ago, which about 90% of the earnings base was in the tax base, you pick up another $75 billion a year, right? So this is not a lift which is impossible, particularly if you think about a few of these things. The one I have not mentioned is the value-added tax, right? A 5% value-added tax, bringing the U.S. in consort with most of the rest of the industrialized world. At a 5%, you could raise between $250 and $400 billion a year. 10%, that's actually in the range of getting us in to be able to try to narrow the deficit that we've talked about and bring it under control. So at this point, you're probably thinking this is a little like Alice in Wonderland. Jim is talking about these possibilities, but they're never really going to happen. So why is he imagining that this might happen? So I just want to show you one bit of fiscal stabilization, which happened under most of your watches and narrowed significantly the deficit in the U.S. And this is going from 1992 to 2000. 1992, the federal deficit was about 4.5% of GDP. Okay. In 2000, as you saw before, we were running a surplus of about 2.3% of GDP. Right? So the net change in deficit to GDP over that 8-year period was nearly 7 percentage points. Now, I'm being a little too aggressive because part of that was coming from the economy was quite weak in 1992 and it was stronger in 2000. 2000 was a really go-go year until the dot-com bust. 1992 was a really crummy year, and we basically really only narrowed by about 4.5% of GDP if you thought about this on a full employment basis. You've standardized for the level of the macro economy. But 4.5% of GDP is more than we need in the tables I showed you before. Where did it come from? Okay, and remember for a second, and this is kind of remarkable, 1992 election, right? Ross Perot, third-party candidate, attracted 19% of the popular vote on a platform which is primarily, I'm going to narrow the budget deficit. Okay, it's only less than only more than 30 years ago, so things can evolve over time. Okay, but the Clinton administration came in with people like Bob Rubin in particular making the case we need to take this seriously, we need to try to calm the bond market and convince them that we're going to get the deficit under control. So what you see is that income taxes go from about 7.5% to almost 10% of GDP over this time period. That's partly the Clinton increase in taxes in 1994. It's partly the effect of government of strong output and strong GDP over the time period. Defense spending declines by nearly 2% of GDP. So that was the Cold War, the end of the Cold War dividend. And of course, we're unlikely to repeat that again. But interest payments also come down by 1% of GDP. And that gets to that's kind of my ideal transition point to talking about the fact that, this reminds us that we need to think about the cost of federal borrowing as well as the level of debt that's out there that needs to be held by the public. Okay, so this is the transition point where I'm moving from what I would call the public finance or the macro of this to talking more about the financial economics and jumping into the interest rate here. So let me start that transition by just showing you a completely different perspective on what's happened to federal borrowing and federal debt, which is interest payments by the federal government as a share of GDP. Okay, so if we were looking at this question in 2018 or 2019, I'll code on 2019 when Olivier Blanchard was delivering his presidential address to the American Finance Association on public debt in a time of low interest rates and speculating on whether the interest rate was likely to fall below the growth rate prospectively. It was at a time when TIPS bonds, 30-year TIPS bonds were probably yielding about 1%. And what you saw was that the interest payment to GDP ratio in the U.S., which had been at numbers like 3% in the early 1990s, was at numbers like 1.5% and had been there for most of a decade. Okay, and fast forward, right? That number, comes through. It gets down to about 1.2 in 2015, bumps up a little bit as we go into 2020. It gets about 1.5. But then, of course, what's striking is what's happened in the last couple of years, as this number now, driven by rising interest rates, has basically taken us back to a value that's on the order of 3% of GDP. And depending on which market you are most comfortable thinking about, this is basically looking at the 5-year Treasury yield and looking at the 5-year expected inflation that's compiled by the Cleveland Fed. The red line is the interest rate. The blue is the expected inflation rate. And what you can see is that for most of the period between about 2009 and 2020, interest rates and the expected inflation are kind of playing a game of tag, and it looks as though the real rate is very close to zero in many of these years. Of course, we see in the years since about 2023 the opening of this disparity, and today we have a real rate in that market that's on the order of 2%. The cleanest way to look at this, although it's a thin market, of course, is to look at the 30-year TIPS yield. 30-year TIPS were literally yielding negative values in some parts of 2021 and 22. Today, they're up at around 2.5% in terms of their yield. So, I mean, a breathtaking change in the cost of long-term real borrowing for the federal government over the course of just a handful of years. And it is the case that if you rewind the tape and go back to 2018, 2019, there were voices that were saying, yes, although interest rates are low today, as the stock of debt gets larger, if interest rates go up, this might get a little sticky. And of course, that was a time of secular stagnation and much concern about what long-term growth rates were going to be. So it wasn't that anyone's base case scenario included rapid changes in the interest rate, but in fact, that's what we've seen in the intervening period. And I will leave to some of my macro and other colleagues to help explain why we've seen quite these magnitude of changes, but that's a subject for a different day. How does this all intersect with what I've shown you earlier in the Congressional Budget Office numbers? This is the nominal 10-year yield that the CBO projects going forward. Okay? And I think it's helpful to see this because it basically says they're more or less assuming that current rates will prevail going forward. This chart builds in the sort of 10 basis points the 20 basis points per 10% of debt to GDP, and is essentially showing you what they are thinking. So this scenario might well turn out not to be the path we actually are on. And if, of course, we end up with a higher interest rate scenario, the burdens of what I've shown you will be somewhat greater as we go forward. So, okay. So this at least has introduced the interest rate as a key driver of what we have to think about here. And I'd like to spend most of the rest of my time talking in various ways about the interest rate on Treasury debt and what some of its manifestations are. I fear that it's always a danger 45 minutes into a talk to decide to do some algebra. But I'm going to ask you to bear with me for just a little bit. Okay. I just want to do a little bit of debt and deficit dynamics to touch base on something which I think will set up the transition to the financial economics nicely and also indicate some things about long-term sustainability which are helpful. So I think G for government spending, T for taxes, B for the debt outstanding, and I'll allow little r to be the real interest rate. The real budget deficit, and I say real budget deficit here because there is an inflationary gain on the debt outstanding as the nominal, if I think about nominal interest rates paid, which is what shows up in the actual measured budget deficit, there's an offsetting but unrecorded inflationary gain to the government on the reduction in the real value of the debt stock. So I do this with the real interest rate, little r, and the primary deficit is the thing we call the government spend minus the taxes, leaving out the interest rate in all of this. Okay, so if I think about the dynamics of debt to GDP, and I do a little bit of algebra where I basically assume that the growth rate of GDP is at growth rate little g every year, and I divide everything through by GDPY in this expression, I come up with an equation one line up from the bottom here, which I think will trigger some memories of things around debt sustainability, which is just that the evolution of the real debt of the debt to GDP ratio depends on the interest rate minus the growth rate times the outstanding debt stock, plus whatever the primary deficit is in the given year. So that if you have a larger primary deficit, you need to add more debt, and that is running against the R minus G. If I set the G minus T term to 0, so I zero out the primary deficits, then if R minus G is positive, right, the debt stock is still going to grow. If R happens to be equal to G, I can sustain the debt forever at the given debt to GDP level. And of course, this is the point that Samuelson and Diamond and others made along the way, which is that when you're thinking about what the debt stock can be held by the government, can be issued by the government, is holding debt to GDP constant is something you can do in a growing economy as long as the interest rate is not higher than the growth rate of the government going forward. So you can achieve what I was calling stabilization before, which is holding that debt over GDP number constant And you can do that without actually paying back the debt, as long as you're in a growing economy. Right? It's a crucial thing to understand in terms of what's happening here. And this expression leads to a very interesting discussion around what relevant interest rate should be used in performing this calculation. Okay? And this is one of the places where I think the intersection between financial economics and macro public finance becomes central. Most of the discussion of the R minus G debate concludes on the macro side that this is about the riskless real interest rate. Okay? And then the question becomes, and of course that is coming from a budget constraint in which this is the interest being paid by the government. Okay? But there is a question here about whether that is the same thing as the interest rate that we observe on Treasury debt. So, though many of you here are more qualified than I to speak to questions like, is there a liquidity advantage to Treasury debt? And is that the same thing as, therefore, is the interest rate on Treasuries the same thing as the riskless interest rate in the economy that you'd put into an intertemporal cap-M? Well, maybe not. And if not, then we need to think hard about what exact number we should put into this. And if the liquidity premium was a little number, then this is really not worth our time. But if the liquidity premium might be in the tens or 20s of basis points, then this calculation in a world where the R and the G might be pretty close to each other starts to become consequential. And that's one of the things I urge you all to be thinking a little bit about as we go forward. Okay? So that's the first piece of where the R comes into the calculation. But there are other places, okay? And this is where I want to just immediately switch gears to work that has come explicitly from the financial economics world and thinking about these debt dynamic issues. And this is some of the work that Jiang and Lustig and Van Nieuwenburg and Shaolin have done, which asks, and it's called, I mean, the topic, the title is very evocative. It's a discounted cash flow approach to government finance, right? And what they effectively do is they approach the very same intertemporal budget constraint that I've just written down for the government, and they basically say, what is the riskiness of the stream of future claims that the government's generating and backing the outstanding debt with? And how do we think about this if we did some basic analyst work on how the federal government looks? What would we learn? Okay? And what they focus on, I want to do one more slide with a little bit of algebra here. What they do is to say, let's look at the outstanding debt and future primary surpluses. They take the same equation I started with. They don't divide by GDP. They just do a forward recursion of that debt evolution equation, and they basically show that today's debt must be the sum of future primary surpluses, which are going to be used to pay it back, right, plus whatever debt is going to be outstanding at some far-dated future time. And as long as we impose a relatively standard transversality condition on the problem, so that none of the value of the debt today comes from that infinitely future debt number, it's a kind of anti-bubble condition, we can basically write down a PDV relationship which says that the debt today must be backed by the future surpluses that are going to be paid, going to be generated by the government. Okay. Now, what they then say is, well, how do we make sense of this thing that the CBO is doing, where it's forecasting that we're going to continue to run primary deficits until we get to 2055? Well, we're going to have a stock of debt that's outstanding at that point. It must be that there are going to be primary surpluses after that date, which are going to pay back the debt stock, which is going to be accumulated in the next 30 years. Okay? And then they make the very important point that when we think about this as a financial problem, the sort of the future tax and spending streams that are associated with what the government's budget, with the government's fiscal situation, are timed somewhat differently. So the deficits in some sense come early, the surpluses come late, which means that as you change the real interest rate, if it changes forever, you actually, because of the duration mismatch, you lose more value on the primary surpluses that are in the future than you gain on the reduction in the cost of the near-term primary deficits. Okay, and the other important insight they raise is taxes and spending are not riskless. Okay, everything that I've told you up until now treats G and T as though they are just predetermined ultimately, right? That we're just writing down numbers and yeah, Congress might do this or Congress might do that. But taxes are a claim on real activity, and government spending is larger when we run into periods of significant downturn in economic activity. So we need to think about the risk nature of what's going on. And what the assumption that's made in the research program that I've just described is basically to assume that the future T minus G, the future primary surpluses, have a risk profile that is very much like U.S. equities. Okay, so that essentially you're thinking this is an unlevered claim on the U.S. economy, and that's what the government's got. Now, if you do that, you replace the R, which was the riskless interest rate, with something which includes the equity risk premium, right? And you've now got a much bigger discount rate as you go forward with this. When you do that, the far distant surpluses that are going to be raised after 2055 have much less value. And this leads to some, I'll call them interesting questions about the fiscal sustainability of the outstanding debt stock, and questions about whether the debt stock, in fact, is larger than what can be justified by the profile of future primary surpluses that we see going forward. So I'm not going to delve into the nuts and bolts of that, but I think the crucial question that I want to raise for your consideration is, how do we think about the riskiness of these tax and spending flows going forward? Because unlike the cash flows of a firm, where the firm is trying to sell its product, but there's not a whole lot it can do to mandate any consumers from purchasing its product, right? That's just not in scope. The government is an entity which actually has enormous powers of compulsion, right? And we've learned in the last 9 months that there are things that might be used. Export licenses can be sold. There are various other things the government might do besides just using the traditional tax powers that it has at its disposal. So I think that a very interesting question for discussion as we go forward is going to be, how does the risk stream associated with tax and spend fit into a traditional financial economics model? And how do we bring that kind of modeling into the discussion about the sustainability or lack thereof of government spend and taxes as we assess the U.S. fiscal situation and think of this going forward? So if you were putting on your hat of the investment banker trying to value this enterprise, how would you do it? And I haven't even touched on issues like the off-balance sheet assets that we don't see. You could sell Yosemite, you could sell Grand Canyon. There's a lot of things out there that you could think about, but those are not captured in any of the discussions that we've seen around what the nature of this is. I think that the question of the dynamic response to the shocks that might come along from the economic side is really a very neat question to think about. So let me show you a little bit on what we know about the kind of response that takes place. Does the Congress kind of lean against the wind when it sees the debt to GDP running up? I'm going to show you something that's a little dispiriting, I must say. This is a graph that was put together by my colleague, my friend Alan Auerbach, that shows how, as the debt to GDP goes higher along the horizontal axis to the right, the vertical is the deficit reduction enacted by Congress in a given year. Okay, and this is for the period 1984 to 2003. And what you see is that in years when the debt to GDP is higher, okay, so that the deficit as a share of GDP is higher, you tend to see more deficit reduction, right? So Congress tries to offset when it sees something in that period. Fast forward to the period post-2004, what you see is the green line is the same one that I showed you a second ago. Okay, we've elongated the horizontal axis because you need to have higher deficits as a share of GDP along the horizontal. But you see that the vertical slope has basically disappeared. So in the last 20 years, there's been very little evidence of any kind of response to the kind of shocks that are pushing the deficit to GDP up. And I think that the challenge that I don't have an answer to for you is, are we in a world which is permanently like this, or are we likely to see some return to the pre-2005 era at some point as we go forward, and if so, when? And that's also, I mean, this is a poor man's version of asking the question, are debt to GDP, is debt and GDP co-integrated? And there's various work that suggests that while debt to GDP does not seem to be stationary, John Campbell and collaborators have done some work on taxes, spending, and debt to GDP. Taxes, spending, and debt do seem to be co-integrated. So, there's some tricky time series issues to explore here around the interrelation of these various series that I will just, again, tee up as part of what is interesting to think about as we move forward. Okay, so the last couple of minutes, I basically want to just talk about two issues that are, related to what I'll call debt market warnings that we've seen. And what do I mean by debt market warnings? Well, if you're a follower of government bond market news, two things have happened in the last 3.5 years that might have caught your eye, right? First, the UK mini budget in September 2022 created some turmoil in the gilt market in the UK. On September 23rd, there was a Trussonomics mini budget. It promised to increase the budget deficit. It was delivered in a process which did not follow the usual protocols for budgets in the UK. The result of which was 30-year UK gilts, which had closed at 377 on the 22nd of September, closed at nearly 5% and traded at over 5 just 5 days later. Okay, that kind of disruption in a long-dated bond market is dramatic. And by the morning of 9/28, the Bank of England had basically come in to intervene and try to stabilize the gilt market. Okay, now, if you remember, the details of this involved a lot of liability-driven investment on the part of UK pension funds, which were kind of caught in if you think back to the portfolio insurance roll in 1987, they were kind of caught in a spiral of the same kind, where basically as gilt prices declined, they needed to enter the market and sell, and therefore this was a sort of self-reinforcing cycle. But it kind of reminded you that in relatively thick markets like the UK gilt market, you could end up with something looking a little frothy. The US Liberation Day, April 2025, was the more recent example of this, right? And this, of course, happened after the president announced that we were going to impose large-scale tariffs on many trading partners. The absolute changes here were smaller, but the 10-year Treasury, for example, rose from 4 on Friday, April 4th, to about 4.48 a week later. It recovers to back down to about 4.3 by 2 weeks later. And of course, there was some intervention at this point on the Fed's part and other things to try to make sure the market stabilized. This is what the president basically called the yippiness in the Treasury market in the U.S. But this kind of a change, this magnitude change, is significantly larger than what we had seen in many previous periods of time. So, these are things where the operation of the market itself and the notion that there might be liquidity disruptions and then significant pressure on prices and significant increases in yield could play out. One of the explanations for what was happening in April 2025, and I commend the paper by Jeremy Stein and Anil Kashyap and several other co-authors, has suggested that the composition of ownership of the Treasury market has changed over time, and that hedge funds engaged in basis trade holdings have become a much more significant part of this marketplace, and consequently, the days when most of the Treasury market was held by central banks and other very long-term holders have been replaced by a period where there's actually much greater potential volatility in terms of what these sellers might do, and therefore we need to be thoughtful about how this market is evolving. So with this warning, I just want to tee up two issues that I think are highly relevant for thinking about on the public debt from the standpoint of financial economics, and where I think the integration between those who think about debt and deficits and those who think about financial markets could really benefit. Right? One is maturity structure issues, which is how do we think about what you issue if you're the Treasury Department, and what are the consequences of that? And the other is this point about the composition of ownership and what we see there. So, if you look back, and I won't try to click back to it, but my slide about the interest rate on treasuries, right? In retrospect, there's lots of discussion about why didn't the Treasury issue much more long-dated debt in 2018 or 2019 when yields were so low. It was a steal. We should have basically loaded up the debt, and then we wouldn't have to worry about refunding a third of it in 2026. So anyone want to, show of hands, anyone want to know when was the last time the U.S. Treasury issued debt with a maturity longer than 30 years? The Panama Canal bonds, 1911, okay? And actually, even before that, the U.S. Treasury issued consols in the late 1870s, although the way these were structured, they only said that they did not ever have to be called, but they had to be 30 years of duration, and they had to be 30 years long, but they could be called after that. And in fact, most of those were called not too long after they reached their thing. But the U.S. Treasury has not issued super long debt, although as many of you will know, some private sector issuers have gone out with century bonds and other things like that, taking advantage of what might be historic lows at some points along the way. Why does this matter? Okay, well, if there's a steeply sloped yield curve for treasuries, Or if you're trying to game the variation over time, not saying you could do it, but if you're trying to, the variation over time and what those rates might be, that suggests that thinking about trying to issue long-dated bonds at times when it's an attractive moment might be attractive from the standpoint of the Treasury. So how do you fit together all of the pieces of what goes into thinking about Treasury maturity structure? It's a complicated question. Okay? The paper that I found most useful in thinking about this is some work by Greenwood and Hansen, Rudolph and Summers that basically points out that you need to think about the liquidity premium government can collect by operating at some maturities versus others. You need to think about the risk of having to refund those short-dated bonds when they come due in relatively short time period. You need to ask what the market participants who are holding the long-term bonds demand for absorbing the long-dated interest rate risk that they are, of course, taking on. And then there's an interesting additional issue that comes to the topic that those of you who think about overall financial stability would focus on, and that is whether if the government issues short-term bonds, it actually crowds out private liquidity creation at the short end of the maturity spectrum, and whether that might actually have some spillover benefits in the sense that it will stabilize the financial market going forward. So many considerations to think about as we try to understand what's happening in the maturity structure. And I would just say, there are some interesting puzzles to think about with regard to maturity structure. For those of you who have grown up, as I did for a long time, thinking that the Treasury must be the lowest cost issuer at any maturity, it turns out that Microsoft, Johnson & Johnson, they issue 30-year debt that's got a lower yield than Treasury debt, at nominal 30-year debt that's got a lower yield than 30-year Treasury debt with some frequency. And a number of large industrial issuers have done that. What that basically suggests is that there is something going on in the marketplace where there are some investors who are prepared for liquidity reasons or for other considerations. I don't think anyone thinks that Microsoft and J&J are less risky than the federal government. But for reasons having to do with the market microstructure of the Treasury market, that there may be reasons why these other issuers can be more attractive. Okay. Second thing I want to focus on is who owns the debt. Okay, and this is the last thing I'll talk about. This just shows where we are today. Remember, there's about 30 trillion of this debt outstanding. Japan is holding a number at this point, which is about 1.2 trillion. China, which used to be a much larger holder, is today holding around 700 billion. The UK is in between at around 865. And then we see a number of other countries that are there. But one thing, two things have happened over the last, I'll say, 15 years. One is the Fed has gone on a remarkable ride in terms of its ownership of Treasury debt, and this, of course, is the flip side of QE2 or QE and various things, with a very substantial run-up in the federal debt held as a share of GDP at the Fed, and now the run down in the last couple of years. So as the Fed has been moving, the question is, well, who else is coming in and doing this? And without getting into the nuts and bolts of the details, one thing that's attracted a lot of attention recently is the growing role of hedge funds that are in the Treasury market, where they're essentially participating in a basis trade and holding treasuries, often in offshore accounts at the Caymans, that are now part of the external ownership of the Treasury debt. And I'll just show you one number that was put together here by some folks at the Chicago Fed. This is actually the Washington Federal Reserve. This basically just shows what's happened over the last few years in the ownership of Treasury bonds by Cayman domiciled entities, and we've now moved to something close to $2 trillion of that, up from a number that was only $600 billion as recently as, say, 4 years ago. And what I think the bottom line in this happens to be is that we are seeing an evolution of the ownership of treasuries shifting from what have been these historically stable long-term buyers to a potentially more runnable market. And that, of course, might have consequences for the operation of the market. And I'm not going to try to go further than that, but I hope that entices you to think about, there might be some more of this linkage between the financial market and the microstructure stuff and intermediary asset pricing, and asking the question of who's owning this stuff, with the issues around how does the Treasury's capacity to finance itself at different maturities play out. So with thanks for your attention, let me conclude. First point, we are currently, with current policy, on a trajectory which is unsustainable, which just means that the debt-to-GDP ratio looks like it's going to continue to grow for as far as the eye can see. Second, if If you run back with the recent fiscal history, low interest rates proved absolutely central to managing the burden of the debt for much of the first 2 decades of this century. But the jump in interest rates recently has led to a significant increase in the burden of that debt in terms of federal interest as a share of GDP. Given that the maturity of the US debt stock at the moment is about 6 years, that's something which is going to continue to play out as we refinance the debt that we have on the books over the next few years. Higher debt to GDP does come with costs in terms of the productive capital that it crowds out. And it comes along with less future flexibility in terms of the fiscal system. You know, at some point, the ability to borrow might be constrained, and that would limit your ability to respond to a crisis, whether it's COVID or the global financial crisis. At least by my lights, thinking about the role of the Treasury market functioning is very important here, and we need to do more of that. But I'll say that the challenge, I think, to the market microstructure experts is to help distinguish which things in the market microstructure literature are big enough that they count for 10 or 20 or 30 basis points, and which things are not, so that we can focus on the ones which are consequential for the R minus G calculations that I showed you earlier. And finally, we should keep an eye on who's owning treasuries, not because we're necessarily going to restrict it, but because the ownership composition of the Treasury stock may be consequential for some of the issues around the financial stability issues that we've talked about. So let me thank you all for your attention. I hope that this has been interesting in terms of pulling together different strands of work related to the debt to GDP and the deficit in the US, and I would be delighted to take some questions if there are some. Thank you.
So we thank Jim for the bounty of information and insights, and we still have some time for questions. If there are questions, yes.
My understanding is only about 7% of U.S. Treasuries are TIPS, Treasury Inflation Protected Securities. Why do you think there isn't more demand for TIPS?
I somehow have a feeling that the answer's got a lot to do with behavioral economics and probably some relative limited financial literacy about folks. I know that my friend Larry Kotlikoff, those of you who follow Larry's blog, has been saying that at 2.6 as a real yield on 30-year TIPS, this is a screaming buy. And anyone who thinks that that's not a great return for the next 30 years, given all the uncertainties, is not paying attention. I think very few people are doing the calculations that Larry's doing, both because I don't think they fully understand the role of inflation in eroding their purchasing power over a long period of time, and you know, understanding how the TIPS bonds work is just a little complicated, right? So I find that the answer for the household sector. I think, Jay, the puzzle I find is that for endowment investors and others who I think are sophisticated enough to get the picture on this, that's the group that I don't fully understand why they don't think that this does the trick. I assume that the answer there is that they think that they can earn significant risk premia by holding other assets, that risk assets are going to be a better deal for them for the long haul. Those who've done that, you know, for the last few decades have basically done well. But of course, you know, the CAPE calculation today would suggest a relatively low expected return on equities going forward. So whether or not they're going to have the same view if they've done it for the next decade, I think will be an interesting question. I don't think I can do much better than that as an attempt at an answer. I do think, by the way, the role of the TIPS market here is important, because if we are thinking about the ability to inflate away the debt, the TIPS is not a big enough piece at the moment that it emerges. But if people read The Economist magazine with the pull here for inflation, that might get you thinking about maybe I'd feel a little bit safer if I was in a TIPS type haven. Yeah, I think it's important. Yes, sir.
The Fed seems to be obsessed with so-called R star, the overnight rate that would lead to perfection and we all live happily ever after. But Treasury securities have a longer term. Are you aware of any work that looks at what I would call the term premium star, so that you can combine R star with the term premium star to come up with the optimal interest rate for Treasury securities, so it makes us live happily ever after?
Okay, so the simple answer is, first, on the framework which you sketch at the end, right, I'm completely aligned with you on that's the thing you need to answer this question about, how do you think about the gains to being at different places along the term structure and what you issue. My pedestrian attempts to find that in the literature did not succeed. There are some calculations done at various of the Federal Reserve banks that get close to that, but then to get to what I would have loved to show you, you need a difference between the different things. And in an audience like this, when I'm not completely comfortable, I'm at the edge of my comfort zone, I wasn't sure I was comfortable they were so comparable that I could take the difference between two of them and stand here in front of you and show them. So I think there's things that get in this direction and try to get at both time series for a given maturity and then a little bit along the maturity spectrum, but I haven't seen anything that quite delivers what you're after. I think it's a great question. Yeah, thank you.
Yeah, it was great to hear you talk about debt maturity structure. I've got a question which might be slightly unfair, put you on the spot, but forgive me, I'm not so familiar with US fiscal history, but with UK fiscal history, there's been a very big break in debt maturity policy that traditionally, in the gold standard era, when long rates went up, so typically in major wars, the government still tried to finance as much as possible, like at the long end, so in terms of perpetuities, consols. And then inevitably during the war, some short-term debts were built up, but at the end of the war, they, again, try and term out the debt. And so the way they did that without locking in long-term rates is they had these conversion options, right? So, and that had kind of the obvious benefit is that they weren't locking in these high rates forever, and yet they were still dealing with, keeping refinancing risks under control. But also incentivized good fiscal behavior after the war, because after the war, if you demonstrated prudent fiscal behavior, then the market price of debt would rise, and you could exercise the conversion option and get coupon rates down again. So my question is, do you think such an arrangement could work these days, or do you think we should be thinking about these kind of ideas today?
Let me start by saying I want to combine that with Jay's question for a second, because one thing that I remember historically hearing in the U.S. was that the fact that inflation was painful because it imposed some costs on those who were the owners of nominal assets like treasuries, right, was a deterrent to allowing the inflation rate to rise. So one thing that you have to think about here is, and I think is exactly, of course, what you're saying with the fiscal response, but there's also a monetary response. If we went to a position where a lot of the outstanding treasury debt was TIPS and inflation indexed, then the cost imposed on the treasury holders is smaller, and perhaps that gives the Fed a little bit more license to think about running the inflation rate a little hotter and things like that. But I think the implicit premise in what you said, which is that depending on what assets the government has, what the government's liability mix looks like, you have to think about the endogenous response to that is important. I will also mention one other thing that I just can't resist here on the inflation and the cost here. If you look at the aftermath of World War II, okay, in World War II, real debt per capita in the US declined by 45% between 1945 and 1955. Okay, that was partly repayment as a result of running some surpluses. It was lots inflation after the war running this down. Okay, it's an NBER working paper that looks at the political consequences of the post-war inflation. Okay, and what it does, how people find these identification strategies, my hat's always off to them for doing this. The intensity of war bond issue campaigns differed across counties in the US, perhaps because some counties had a very organized bond selling machinery and others did not. If you look at the counties where war bond sales were larger during the 1941 to 45 period, and therefore where the inflationary expropriation of value was greater for the residents of the county in the subsequent decade, and you look at the change in the Democratic vote share between the 1944 election and the 1952 election, you find a quite statistically significant effect that at counties where people were holding more war bonds, they moved significantly away from the Democratic Party in the intervening 8 years. Okay, so this comes to the dynamics of what the policy mix looks like as a function and the political repercussions and all this. All right, so haven't quite come to your question, which is how do you think about having triggers and other things like that to move forward? I am in general a bit of a fan of trigger strategies like this, and whether it's purely on the financing side, you allow yourself to sort of automatically refinance when rates move in a sense that you don't have to take a positive action, because there's always a sense that if you're the Treasury refinancing at a given point in time, does the market conclude that you think that there's about to be a change in the trajectory of rates, and that's why you're refinancing today? So it's a little bit like if you're a corporate executive selling stock in the company, you'd prefer to say that you've done it under a pre-specified plan than that you were taking advantage of the high stock price today. There's another element of this automation in this that I can't resist telling you about. There's a recent paper by Doug Elmendorf and Karen Dinan that looks at automatic stabilizers this is coming back to the public finance side, which is, if instead of just saying we're going to ramp up spending and then take it down when we get around to it, we say we're going to put in automatically something which says we're going to reduce the generosity of unemployment insurance benefits when the unemployment rate hits X, or we're going to raise taxes when the debt-to-GDP ratio gets to Y. They run a scenario with a couple of these things through the pandemic. And what they find is that an automatic stabilizer actually would have left us with a smaller debt stock on the back end of the pandemic. And it's not because it would have slowed the clicking on of the programs at the beginning when we were in, say, March of 2020 and doing things like that, but because it would have sped the wind down of programs if you had automatic things which were going to pull them back on the back end, because it turns out that it's hard to pull the stuff back. And this is something that I think is interesting. So I think it's a long-winded way of saying, I think what you're navigating toward, which is saying maybe putting some of these things on the fiscal side on a little bit of autopilot is something which is worth thinking about. You do want to be careful when you issue these implied puts that you give to the marketplace in some things. The market's often very smart about this. And at one point, the Great Britain funded itself at one point by selling annuities. And some of you, this gets off our topic, and I'll come to your question in a minute, but in some of my other life, I'm very interested in the annuity market and the history of annuity markets and adverse selection. I see my friend Olivia Mitchell, who's equally interested in the annuity market. If you go back to the early part of the 1800s, this is maybe the 1600s, when the UK was first selling annuities, right? So these are annuity products which say, for the person who's the beneficiary, you're going to get a stream of income for as long as they're alive. You could denominate a person who was not yourself as the beneficiary of the annuity. The UK was selling these annuities. Swiss and Dutch syndicates came and purchased the annuities in London on behalf of 5- and 6-year-old girls, knowing that they were old enough to have survived childhood illnesses and likely to outlive their male compatriots. And the UK was selling these annuities at a one-price-fits-all, and the Dutch and Swiss syndicates did very well by trading against the UK with the products which were issued. So I think there's constantly a concern that when you offer something which is going to allow a trading opportunity for the other side, you do need to be careful if you're the government. So thank you. Yes.
That was very interesting. It's okay that you made me wait. I have a question. Actually, it comes around both the debt holders, composition changing, and then also the debt structure. So with the Genius Act that recently passed, the US government mandated that stablecoin issuers in the USA be back their holdings one-for-one with US government debt, Treasury specifically, of less than 90 days. Tether by itself is already the 8th largest holder that we know of US Treasury. So that's a huge increase in demand for US government debt. And so I'm curious, if you keep that in the back of your mind, how do you see these forecasts playing out now that the government essentially through policy has mandated this purchase of US government debt, locked them in?
It's a fantastic question. And I'm going to first disclaim, I'm nowhere near an expert on the Genius Act or on stablecoins, but I am going to turn your question into say, this is in some sense a form of financial repression, right? I mean, if you'd invited Ken Rogoff or Carmen Reinhart to come and talk on this issue today, one of the things, and some of you will recall their book back in 2009, which was This Time It's Different, which, I mean, one of its key conclusions was when debt to GDP gets to around 90%, the economy starts to perform in a wobbly way. Of course, we've steamed right through that, and we haven't seen that particular outcome. But one of the things that they distilled from their analysis of the history of government borrowing was that when debt stocks get large relative to GDP, you begin to see things which require some participants in the economy to hold the government debt. Now, I actually had a slide that I didn't get to today, which I was going to suggest that we could see at some point mandate that pension funds need to hold a particular fraction of their assets in treasuries, and that, of course, would be a captive market, as it were, to absorb some of the 150% of debt to GDP that might be out there. The issues of the stable coins is exactly the same sort of thing, right? And I mean, I would not want to conjecture whether, in the spirit of doing, we need to make sure there are relatively safe assets backing some of these things, specifying that that's going to have to be treasury debt is in some sense a way of pushing out the demand curve for treasury bonds, just as you said, and that potentially becomes a significant part. Now, that would work in the opposite direction of what I was talking about, the hedge funds who can run quickly doing this, but it also, of course, exposes you to a risk, to the run of a risk in the stablecoin market, turning out to suddenly create a follow-over effect in the treasury market, which is something I'm sure has not attracted a lot of thought in that process. Yeah, thank you. Yes?
Hello there. So I'm a public finance economist, and I have two questions for you. One of which you mentioned in terms of the increase in spending is that it's a lot in the mandatory spending programs, the Social Security, and you mentioned how politically unpalatable it would be to reduce benefits to Social Security recipients. But if you think about the other driver, that's driven by healthcare spending, so Medicare and Medicaid. And what about, so my question here is that what about the possibility of reducing reimbursements or engaging in negotiations with, for instance, pharmaceutical companies, saying that similar to what much of what continental Europe does is that we'll not reimburse you at this rate, we'll reimburse you at a much lower rate. So similar negotiations with pharmaceutical companies or medical providers saying that the reimbursement rates will be a lot less generous than what you have been used to. So that's one question. And the second question, I focus mostly on state and local governments. You didn't touch upon them, so I'm curious to know of what you think about what the effects of the fiscal picture would be on the state and local government sector. Thank you.
I'm going to give you a quick answer to the second and a long answer to the first. Quick answer to the second is, I think there is some shared fiscal capacity, as it were, shared fiscal space between the state and local and the federal. But I think that there's, to a first approximation, I'm not too worried about the feds crowding out state-local issuance along the lines I'm talking. The long answer to the first one is, I think there's a very big difference between Social Security reform and Medicare and Medicaid reform, in that Social Security is basically a relatively straightforward accounting problem that, I mean, if Wei barred the doors and said we had to agree collectively before we could leave this afternoon on a set of reforms that would bring Social Security into financial balance after 2033, right? We could specify an increase in the retirement age for future retirees. We could increase the tax on earnings. We could increase the earnings cap. We could decide to index inflation, index a little bit less for inflation than we currently do, or to fiddle with the rules. We could change the progressivity of the benefit formula. Those are 5 options. We could mix them together in a bowl and decide what we liked in terms of the proportions, and we could come up with a plan which would basically get Social Security back on track. Okay, so she wouldn't keep us in the room very long if we were well motivated, if that was our task. If she gave us a different assignment and said, come up with a fix for US Medicare and Medicaid spending going forward for the next 30 years, we would quickly, as we began, just as you said, to discuss, should we change reimbursement rates for pharma firms, get into a debate about the consequences for innovation and whether that was going to cut off the pipeline which would deliver GLP-1s. When we began to think about changing the hospital reimbursement rates, we'd ask the question of whether rural hospitals were going to close and we're going to have healthcare deserts. When we get into we'll push it all onto, maximum staffing regulations. We get into people who said that the critical care hospitals, which traditionally had more demanding patients, were going to be burdened by this, and the hospitals were going to cream skim to try to get out the way. There's a whole lot of behavioral response to all the things we might do around Medicare and Medicaid that are complicated, okay? And I don't think we know, my health economist friends might disagree, but we're still at least debating how many of those pieces might work, okay? So that's a really hard set of issues to look at. And to make it more complicated, you know, the projections about when Social Security is going to run out of trust fund dollars have changed by a couple of years since 2002, but nothing dramatic has happened to the demography of the US economy as we go forward. But the relative growth rate of healthcare spending in the US, which was on a tear until about 2012, then like slowed down for about a decade, and like why? In the last couple of years, armed partly with the GLP revolution, it's run up a lot. So it feels like we've got much less of a handle on that set of issues than on the Social Security. So if I had to pick, I'd say, you know, give us Social Security any day. We'll try to work on that problem, but spare us from having to solve Medicare and Medicaid. But I do think, you know, this suggests to me that it's good that the order in which these problems come along is Social Security first, because if we can't get to a reasonable solution around Social Security, the chances of getting to something sensible around healthcare is going to be even harder. So but a great question. Yeah. Cam.
Thank you for doing this lecture, and it's great. I've got a question about, you mentioned the changing potential composition of debt in the future. And one thing with the US is that 1/3 of the debt is held by foreigners. So it's much different than Japan. So I'm wondering what your opinion is as people talk about the so-called de-dollarization, central banks trying to diversify out of dollars, China having now 32 different bilateral swap lines to get around using the dollar. So what is your opinion of that potential force in terms of potentially increasing the interest rate burden?
Yeah, I will confess, Cam, I can't go much further in terms of the facts than those that were embedded in your question, right? We know a couple of things have been happening in the last year or so, right? The run-up in demand for gold seems to be in part driven by sovereigns that are trying to, or central banks that are deciding that maybe holding dollar reserves is not quite what it used to be, and they're moving in different directions. The Chinese embarked on a plan of reducing their holdings of Treasury debt a number of years ago, and they've been on a run down in this profile. So my best guess is we are in a period in which there is going to continue to be significant transformation of the ownership structure of the outstanding Treasury stock. And I think, and I mentioned briefly, but it seems to me that this is a place where the intermediary-based asset pricing literature, which has begun to spring up, is going to be very relevant for understanding what this might do. Because the ultimate goals and objectives of these different investor groups are probably quite different with regard to the role that the treasuries will play. Where at the extreme end, we have the swap activities, which are transforming the physical, the actual bonds of the Treasury end of the long end of the Treasury maturity spectrum into some financial security which can be held by some institutions, whether they be insurance companies or others, who don't want to use up their balance sheet by holding the actual bonds. That's something which is the financial engineering of which could be extremely elastic over time. Whereas traditionally, when you were a central banker in a middle-income country and you were holding Treasury bonds as part of your reserves, that was a very inelastic type of demand. So I think this is something, and we've seen the work that Anil, Jeremy, and their collaborators have done. We've seen others who've begun to talk about this. Wen Zhindu and her collaborators have been working on some of these issues as well. I think we are beginning to see people who are focusing on what's happening as this ownership structure changes. To me, it feels like one of the big topics that requires attention to look further. Yeah, but thank you for raising it. Yeah.
Yes, thank you so much for talking about this topic. I'd like to concentrate more about the issues on the credit markets right now. You mentioned the basis rates that happen around Liberation Day. I guess is in your basically what I'm looking is, what do you see as the likelihood of these things continue? Either negative swap rates or swap spreads, or we're looking at maybe another issues with the basis rates again. And then some things that the Federal Reserve is doing, like eliminating QT, for example. What other things might the current Fed could do, to avoid these issues coming up?
Okay, so I'm not deeply enough in this to be able to give you a really satisfactory answer, and I apologize for that. I don't see any particular reason to think that what we experienced in the first half of 2025 was an outlier. And I think it probably is a reflection, and it really is a natural connection to Cam's question of we're in an environment in which the traditional Treasury market has been evolving to something which is a different market as we go forward, and we're learning as we go about what some of the dynamics of that market might look like. Now, of course, apropos the question before about the Genius Act, there may be things that change along the way which have repercussions for this, and I will leave it to the much more expert folks in the room. There are probably places where this intersects with going back to the to regulations that were enacted post global financial crisis that changed the role of dealers in the marketplace and the liquidity there. And certainly one of the antidotes to some of the things that we've seen might be loosening the roles of loosening the bounds on what some of the primary dealers can do and expanding their capacity to play in the marketplace. But those are going to be things we might see as we go forward. I think that the good news in some sense is that the experience in both the Trussonomics budget situation with the interaction by the Bank of England and the experience in April of 2025 in the US were relatively short-lived in the sense that they resolved themselves, and we seem to kind of go back to something that was reasonably close to the ex-ante in the Treasury marketplace. I think the real worry, and this is the place where I don't have a crystal ball that I can look to, is at what point do we start to do things here that might be consequential enough that it's really hard to unwind and put the genie back into the bottle, right? And that to me is the place where, again, I offer that as really a challenge to the group to begin to put on our thinking caps and say, let's try to scheme out some of the things here which could be problematic. And I think that, I really like the question about the Genius Act because it does remind us that you can change something one place in the system and suddenly you have just linked together Treasury demand to the stablecoin market, and that might not be something that you were intending to do. And the goal that led you to say we're going to have this backing requirement of Treasuries might have this, this kind of externality on market structure that we hadn't thought through. Yeah, very good question. So take last question.
I'd like to get your thoughts on changes in Treasury market structure to make it look more equity-like. Now, in the equity market, we're very proud of the fact that prices respond very quickly to information, and we view volatility as not necessarily a bad thing. Yet, one of the major value propositions for Treasuries is their stability as a store of value. And we have a lot of things like more transparency, central clearing, and other proposals to make the Treasury market more equity-like. And I'm just wondering what your thoughts are on that, and could we be going too far in the equitization of fixed income?
Again, I'm just skating at the edge of what I feel comfortable with here, but my general instinct is that the market participants in the Treasury market are pretty sophisticated in some cases, and that figuring out how to get, even if it's not accessible to me as looking in the table in the old print FT or the back of the Wall Street Journal where it doesn't appear anymore, or looking on my Bloomberg terminal, even if I can't see everything that's there, the folks who really are making this market happen are able to judge much more accurately what's happening in real time and what those things are like from swap markets and other derivative securities that are available for them to look at. So I don't think that I think that there's probably, if there is a sense in which it looks like it's pretty stable to some, there are other market participants who are probably seeing the action closer up and understanding what's happened. So I'm not particularly scared about trying to go in a path that allows things to be more transparent and let people see what's happening. So that's a great note on which to stop. So thank you.
Thank you, everyone.